Everyone, you're welcome to my channel, Sunday here, and you're welcome to Against FX. If you are new, please do subscribe to our channel, and so that you can get the best out of it. All right, and we do offer mentorship. So if you want to learn how to trade, please do contact us so that we'll train you. All right. So it's very, very important. If you want to learn how to trade, contact us. All right. So today I'm going to be teaching you guys how you can refine your entry. All right. Now, if you're already a trader and one of your challenges is how you can refine your entry, because that is the problem of most traders, all right? How you can refine your entry. You want to know when, at what point should you enter the market? And that is what makes you a good trader. If you want to be profitable, you must learn how to get into the market or get involved in the market at the right time, not just jumping into the market without any reason. Or you just see a bullish and engulfing candle, a bearish engulfing candle, you just jump in. No, there has to be a reason. That is why you must, first of all, have a plan, have your own trading plans, all right? Have your rules that you must follow, all right? So today I'm going to be showing you guys, because everything is based on structure, because if you don't know how to read structure, it's going to be difficult. Because a structure that will tell you everything you need when the next move is a structure that will show you. All right? Because market structure refers to how currency price move and behave over time. Based on the interaction between buyers and the sellers in the market. All right, so it's very, very important you know market structure. So with that, you'll be able to time your entry. Some people will call it sniper entry. Yes, it's a sniper entry because that entry is timing. You just know, okay, at this point, I'm going to get involved in the market. So first, when you see a trend like this, all right, going up, breaking structure uh, to the upside, like this, for example, higher highs, higher lows, higher highs, higher lows, higher highs. All right, it has created this high. They now pull back and created a low. The next move that's supposed to happen is supposed to follow the order flow by breaking the structure to the upside. This is where it gets tricky and a little twisted. All right? It's tricky and twisted once it happens like this. And you notice that this move, you will notice immediately that this move, what happened? This is a break of structure. Then this is another break of structure, but very minor. All right? It's just minor. All right? But the thing is, it broke structure to the upside. But look at what happened here. Price broke structure from here to the upside. It now came down, violating this level. See, violating this level. All right, violating this level. And once you see something like this, as a trader, as a professional trader, once you see a push or a retracement that violated the previous low, now what should come to your mind is for you to now say, okay, let me wait for this push and see if this push will take out this high. At this point, you don't need to do anything. All right, that is how to follow a structure. So if there's a pullback, there has to be a push. If there's a pullback, there has to be a push, right? So now we now see a pullback. After this push, we see a pullback, but the pullback violated this last support level. All right, so once you see something like that, you just need to pause because something is about to happen. All right. So let's say, for instance, now the price is here. All right. Let's say, for instance, price is here. All right. You see something like this, it has gotten to this, it created a high. Then what you should be expecting is for price to create a low. Then let's play it for, you see, you now see from this point, I now see, you will see that, okay, it's printing the candlesticks, you see, is printing, then what you should be expecting is for price to come down to this level. It should not violate, price should not violate this low. You see, it has body breaks this level. That means that is a violation. So once that happens, you will also, okay, let's see, as it's going up, let's see if it will violate this high. Let's see. So I'm teaching you how you are supposed to follow it before you take any action. Once you see something like this, you pause. You see, at this point now, price did not violate this high. Look at it very well. Price did not violate this high. It stopped here. That is to tell you something is happening. That is to tell you that something is going on. Because price action, push to the upside, a pullback, push again to the upside, breaking this high. Then what now happened? It now pulled back. This retracement was now deeper. It now took out this low, this support level, which is not supposed to be. This is violation. It's no longer another flow. So when something like that happen, because you are supposed to wait for price to get to this support level, then you enter to now join to push the price to the upside. Now you don't see a violation. Immediately you see a violation, what will come to your mind as a trader? You just need to pause and now watch to see if this push, because sometimes it can violate, then push again to take out this side to continue the underlying trend. That means this one was just used as a liquidity. All right, it was not recognized. All right, it was used as a liquidity. Now, what will happen once you notice this kind of a thing? All you need to do is for you to hold on, because other flows is supposed to push and break this level, taking this level out, then before it will now pull back again and continue going up. But now you can now see that price stopped here now. Let's play it forward and see what happened. So by the time you now see that our price pushed to the upside, but it stopped shy here. So what will now happen? You hold on. This one now will now be used as the last support level. Let's see if it breaks. If it breaks now, if it breaks below this level, you just need to change. Now it has body breaks this level. Now, once you see trend, price action body breaks this level, what you need to do is we will call this a market shift. Market shift has happened. This is where market shift happened. All right, we say market shift has happened, or we call it change of character. All right? Market shift has happened here. All right? We'll say market shift. At this point, when you see something like that, you say market shift. Now, when we say market shift, what do we mean by market shift? We are simply saying that a bullish trend that's creating higher highs, higher lows, higher highs, higher lows, higher highs like this is now shifting. There is now change in trend. You cannot see it's now coming down. So what you now is now planning to start breaking structure to the downside, shifting market shift, shifting from a bullish trend to become a bearish trend. So once you see something like this, you just know, okay, this is the last support level, but this level here failed to do its job. Why? Because it did not take out this high. It did not take out this high. It failed to do its job. So now what will happen? This point now will not be used as a liquidity because it failed to do its job. This guy here will now push and take out this level. Or any level that fails to do its job, the next push is coming back to now take out that level. It will now use that level as a liquidity. Have it in mind that any level at any point in time that fail, if it's a bullish trend, once there's a push to the upside, there has to be a retracement before another push. All right? If the push did not take out, because the idea is that the other flow is that once there's a push to the upside, a high will be created. Then it will now follow with a retracement, a moment of relief, a pullback. After that pullback, then price will now rebound again, then push and take out that high. But once you notice that the push to the upside did not take out the high, you just know that something is about to happen. It has created a lower high. This is a higher high or this is a lower high. Now, price has created a lower high, giving us a hint that there could be market shift. Now, at this point, what should we do? We just need to apply patience and now watch price action to now create that market shift. Then let price like this, after the creation of this market shift, by violating or breaking this support level, we are waiting for a pullback, all right? The pullback to create another higher low that is not higher than this. This push to the upside should not violate this higher low, all right? Then the next thing we need to see is for price to come down, all right? Is for price to come down and take out this low so that the bearish structure will be established. And once you see market shift like this, once there's a market shift, the next pullback should not violate this high. All right? It can create the equal high, that is no problem. But it should not body break this high. As in, the body of the candle should not be higher than the level, the high of this level here. So once this happens, the next thing you should see is for this level to now come, price action should come and take out this low. And once that is done, we now say, okay, here we now know that this is what we now call break of structure. Once that happens, we say break of structure. All right? Once that happens, we say break of structure. All right? Now, once a break of structure has occurred, we now say that a bearish trend has been established. Once you see something like this, you have to wait. No matter the time it will take you, you have to wait for a market shift to occur, then a break of structure to occur. Because price can create a market shift and then push again to resume the underlying trend by going higher again. All right? So you must wait before you be sure that a bullish trend has now successfully turned to a bearish trend. Two things you need to observe. Wait for price to create a higher low. All right? After the last swing high, wait for a price to create another high, create a higher low, then a market shift. Once the market shift is created, wait for a pullback and ensure that that pullback did not take out the higher low. Then another thing that will follow suit is a break of structure to the downside. Once this is established, fellow traders, you just change your bias. Now you will now be looking for a selling opportunity. Once this happens, all you need to do is for you to wait for a price, for you to wait for price action to pull back. All right. Once price pull back to a resistance level, you now watch the reaction, then you will now enter to push the price to the downside. Let's say, for example, now let's play price forward. Okay. You can see it's going, it's pushing back, it's pushing back. So what you should be watching now is for us to make sure that as price is pushing back, it should not go above this level. All right, once you start seeing a rejection here with a bearish candle, all right, a bearish candle at this level, at this point, then we'll be looking to get involved in the market. So now let's play the price forward. You see, bearish candle, but there is no rejection. In this wise, you don't need to get involved because there is no rejection here. You see, there's no rejection yet. Okay, you don't see a candle like this, but you have to still wait because once you see a rejection from this level, then you now know that okay, it's now ready. The price is now ready. The market is now ready to sell. There's no rejection here. You see, there's no rejection here. It's just retesting. The first test is retesting it again. He has retested it here. Look at it. He has retested this line, this level. Then we are waiting for the next touch. Let's see after the next touch whether there will be a rejection. Let's see. This is the first touch. Let's see whether there will be the second touch. You see, this second touch, we can now see that there is a rejection. And what did price, what is this candle called? you can now see that it has created a spiny top. All right? It has created a spiny top. A spiny top always happens at what? At a resistant level. It has created a spiny top. So we should be waiting. At this point, we should be waiting for another bearish candle. All right? At this point, I can confidently get involved in the market like this, putting this stop loss above this high, all right, like this, then you should be targeting this level or this level, all right, targeting this low, because the idea is that price action should come and take out this low for it to create another low, because price action has changed from a bullish state now to a bearish state. All right, so let's see what happens. All right, let's see what happens. Let's play price forward and see what happens. You can see another bearish candle. You see another bearish candle. As a matter of fact, once you see this spiny top, you just know that the market is ready to sell. You can see straight to this point. Straight to this point. So the next push now will now be price pulling back again to rebound, then drop. Because it is now confirmed and clear to us that the market has resumed selling. This is what we call break of structure. Now that break of structure has happened, the next thing is for us to start selling. We should be looking for selling opportunity every time. As far as the market is now in a bearish state, right? It's no longer bullish. At this point, it's no longer bullish. All right, so now when you want to now enter, you see how I entered? Just only this candle, the spiny top, just show to me that the market is about to sell. It's a very simple thing. That is why you have to also learn about candlestick patterns. All right. First, you need to wait for MS to take place. That is market shift. Once you notice that there is a market shift, the next thing is for you to now watch candlestick closely and get a break of structure. The next point is for you to start looking for an entry. All right. So now, once this is going on like this, another thing that will now help you to really refine your entry is by employing what you call Fibonacci retracement tool. All right? Fibonacci retracement tool is very, very important, very, very helpful in refining your entry. All right? In refining your entry, Fibonacci retracement tool is very, very vital. Very, very vital. So once you plot it, for example, you plot from the high to the low here, all right? All you need to do is wait for it to get to what? A premium level. Now, I've taught us before what premium and discount level is all about. A premium level is when a market is selling on a bearish trend from 50% to 100% is what we regard as a premium level in Fibonacci retracement tool. Now, from 50% down to 0%, all right, is what we regard as a discount level. When the market is bullish, all right, you plot from 100 to 0%, all right, you drag it out, you wait like this, for example, like this, you wait for price action to come down to a discount level, just like what he did. He came down to a discount level, this from 50% to 100%. So anything from 50% down, 61.8% is what we call golden ratio. So anything from 50% down, once you start seeing a rejection like this, then you can now involve in the market. You buy. So the idea is you wait for price action to pull back to a discount level, and of which when the market is in a bearish state like this, all right, once you plot from 0 to 100, drag it out, then wait for price to turn back and to pull back to a resistance level where it will get to a premium level. Allow it to push into a premium level, just like what price action has done now is in our premium level. But has it given us entry yet? Let's look at it. Has it given us entry yet? No. It's still going up. It has not given us entry yet. Price has not, we see. Now price is ready to sell. It's ready to sell. All you need to do is take your sell tool, measure it, all right, like this. Then price action will have to break this level to create another low. That is the flow. It will create another low. So you just leave price to play. You leave price to play. Here is the main entry, all right, before price will now sell off. Let's fast forward price right now and see what will happen. You see a sharp rejection here, a very sharp rejection here. You see after this sharp rejection, you now see the massive drop. So you have to always wait for a sharp rejection like this. Then you now see a massive drop. So the idea is for you to know when you are supposed to get involved in the market. You can see we have first TP hit, second TP hit. It's as simple as that, guys. You have to wait. Now that we took this measurement from this high to this low, we only waited for price to play into our premium level. All right, price has to move above 50%. And by the time you start seeing a rejection like this, a rejection, let me clear this so that you can see. By the time you now see a rejection, you see a sharp rejection, this very sharp rejection, but it now range a little. Then another rejection, it retested the same high before it now started dropping. All right, so if you now want to wait for price now, you will now have to come like this plot, this is what, where it broke structure to the low side. You wait for price action to come back again into your premium level. All right? Wait for price to come back to your premium level. And what you have to do is once price plays into your premium level, now once I say premium level, I'm talking about from anything from this point, this 50% to the upside. It can get to 100%, but the only thing is that it should not body breaks this level. It should not close above this level. All right? This is where what we call premium level, all right, when we are in a bearish market. But when we are in a bullish market, this is what we call a discount level. Between here, this 50 to this 50 like this is what we call like this. This is the discount level. This is a discount level. From here to this point is a premium level. Now, if you want to plot a bullish trend, you know that you have to start from the downside, which is the 100 up to the 0%. Now, you now see this point from 50 down, this is what? The discount level. Then from 50 up to 0% is the premium level. So guys, I hope this is very clear. All you need to do is for you to wait for price. Now that price is here, it has created a support here. All I need to do is to bring my Fibonacci retracement tool from this point. This is the high. All right, this is the high. This is the resistance. And here, this is the low. This is the support that price created. All right. This is the support that price created. All I need to do is bring my Fibonacci retracement to plot from up to this down. All right. Then where do I need to be waiting for price? Between this 50 to this 100. I'll wait until price plays into this level, this region. Then I will now wait until I see a rejection, a spiny, a spiny top or a shooting star. All right. Once you see this kind of a rejection, then you just know that price is ready to sell until there is what we call change of character again or market shift. You see, price will do this, then go a little up, come down, retest this level, then you now see price now start breaking structure to the upside. Until you see something like this, until this scenario happen again, until this scenario takes place again, price will continue to sell. The only time you now see a price going bullish is after price has created this kind of a move. For example, by the time you see price is coming down, it now stop, pull back, created a resistance, come down. Instead of breaking this level, it now stops shy here. And what does that mean? Is that this resistance has failed its duty by stopping shy. it was supposed, if you want to follow the other flow, it's supposed to break the structure low to create another lower low. Once you stop, see something like this, and the next move, you see a break of structure to the upside, then the next one is for the price to come, retest this level, which is in the neckline, then before a push, all right? Before a push to the upside. All right, you see price coming to retest this neckline. After a break of, after a market shift, a pullback, then break of structure. So this length line, this is where your entry is. Or you wait for price to pull back again. At this point, once a high is created, for example, once a high is created, this is the low, the pullback, you just wait as the price is coming back. Now we have now shifted from a bearish state. Now, once you see this kind of movement again, then you now see we are shifting from a bearish trend into a bullish trend after this market shift has occurred. And anytime market shift occurs like this, price will come back, retest this neckline. And that is your entry before it breaks structure. Once it breaks this structure to the upside, a new trend has just started. That is a bullish trend. We have now shifted from a bearish trend into a bullish trend. Once you see a market shift occurs like this, you know that there is now a shift. So you will now be, once it happens, you just change your bias immediately. All right? Change your bias immediately. Then you will now be looking for buying opportunity. You wait for price to pull back to a discount level. Now that you have now used your Fibonacci retracement tool, 100% to 0%, the swing low, 100%, the swing high, 0.00%. You wait for price now to now push down into a discount level. Once price comes back into this discount level, you wait for a rejection, all right? Or engulfing candle, engulfing bullish, engulfing candle, or a spiny bottom. Once you see something like this, once you see a rejection anywhere within this discount level, you just enter. There should be no hesitation. Enter, and your target should be this high. All right, because that is what we refer as a turning point. Immediately price breaks this high, all right, immediately price take out this high, there will always be a reaction. There will always be a reaction because price cannot just break the high and start going. No, there will always be a reaction, and that reaction might make price to pull back or just have a little retracement, then continuation. So it's always advisable to target the high. Target the high, and you will not struggle to reach your TP. I hope this is very clear. If you have been trading for a very long time, this video is for you. All right? Trading, for you to be trading, you ought to know what you are doing at any point in time. You don't just take trades anyhow. And don't say because there's an opportunity, you just start taking trades anyhow. 1, 2 trades a day is okay. Don't overtrade. If you overtrade, there is every likelihood that you are going to make mistakes. If you take 1 trade, 2 is okay. You just limit the amount of trades that you take on a daily basis. All right, and you will see that gradually you will just be building your account. Gradually. And don't overstay because you want to make plenty money on one trade. No. Once you enter at a support level, take your let your TP be at the next resistance level. And in the case of a bearish trend, once you enter at a resistance level, your next target should be at the next at the next support level, or you use your Fibonacci retracement to negative 27.00 is always your TP. All right, so now we offer mentorship. If you know that you are interested in forex trading as a beginner, or you are an advanced trader, you are still struggling with some things, just inbox us, all right, againstfx.com. Go there, send us a mail, againstfx@gmail.com. Just send us a mail, then we'll just put you through, have section with you so that we can put you through. Because for you to say that I am a good trader, I'm a professional trader, that means you don't just rush at any trade that you see. No, you have to watch the market first. Know how to read market structure. It's very, very important. You must know how to read market structure. Very, very important. By the time you know how to read market structure, then you will now know where to step in, all right, into the market. You now know where and when to take your trade. And there are things you will see, you just stay away. Allow price action to tell you where the price is headed. Do not assume anything. And apart from that, always follow the higher time frame. Follow the higher time frame. Even if you want to take your trade using the lower time frame, all right, but do your analysis from the higher time frame. Mark your POIs from the higher time frame. So once your POIs are marked, your support and resistance levels are marked on the higher time frame, as an intraday trader, you need to monitor your daily and 4-hour time frame. Once you mark all the POIs on the higher time frame, you can now scale down. By the time you see price is approaching the level, your point of interest, then you can now scale down to your time of entry, then execute your trade. All right, execute your trade. As simple as that. Take 1 or 2 trades a day. It's okay, it's enough. So that emotions will not set in and you start making decisions that are not accurate. And anytime you win, don't be too overexcited. Once you win, at the end of the closing, at the end of the trading day, review review the trade to know for you to know what actually happened. Why did that trade plays out the way it did? Or if you make loss at the end of the trading day, review your trade to know why you made that loss. That by so doing, you are improving as a trader. All right? The only thing that can prove you wrong is the chart. Nobody can prove you wrong as far as you are a trader. It's only the chart. Because by the time you press your button and say buy or sell, The only thing that can prove you wrong at the end of the day is the chart. So you need to know how to read market structure at every point in time. Once you see that there's a change of character, this one now, this level now, you see it's been selling. At this point, it's changing. There's a change of character right here. Look at it. This trend is this is a trend we'll be analyzing until it now got here. All right? It now got here, and it has given us right here a market shift. Look at it. It has given us a market shift right here. A market shift and a retest of this neckline. All right? It has given us a market shift. So once you see this pattern, you just know that the bearish trend has ended. All right, you know that the bearish trend has ended. You look at it. Price came, this was the last low, it pushed to the upside, breaking this level. It's not supposed to do that. Okay, it now came again, it stopped here. It's supposed to push to down, well, it's supposed to take out this low. It didn't do that. It pushed to the upside, it stopped shy. All right, it now came down like this. It created thereby taking liquidity. All right, this was the lowest low. But if you watch something closely, you discover that before the candle closes, it closed higher than this one. All right. Then you now push here, created almost the same equal high, push, it stopped here. Then you now see a push to the upside. All right, breaking this length line before a push to the downside. All right, you now pull back to this line, this level. Then you now see a break of structure to the upside. Now it's pulling back, and this is where we are. All right, so that is how to read market structure. Now, once this kind of thing happened, all you need to do is what? We prepare yourself for a buying opportunity. Buying opportunity. Like here, this is where the last break of structure occurred. All right, the break of structure occurred here. All right, market shift occurred here. Market shift occurred here. You see, market shift occurred here. Then break of structure occurred here. This is the last break of structure. So what you need to do now is plot from here. This is the high. Remember what I told us. Anything from this 50% to 100% is what? Is a discount level because we are bullish now. Why are we bullish? Because price has given us a market shift. So that is to tell you it's no longer going down. Its price is no longer selling. Price action is no longer selling. We are now in a bullish market. All right, it has changed from a bearish market into a bullish market. At this point, you see this level here, there was a change, there was a market shift, a bullish trend changed to become a bearish trend. Market sold up to this level. They now give us a market shift again. Then you now see price going back to the upside. You cannot see. At this point, we will now have to measure from here to this point. Where should we be waiting for price? Price retraced up till it got to this point, this level. And you see, first rejection, second rejection, the third rejection. This one is what? A pin bar. You can see. This is a pin bar. So once market opens, we should be expecting a push to the upside. But another thing we should uh, have in mind is that we have an FVG here. All right, fair value gap here. Price can push a little down to interact with it before it push to the upside. It can just push to the downside, all right, but close above it, all right, but just to interact with it. But whichever happens, once something like this happens, we should know that at this point, we are in our area of interest. So we should now be planning to get involved in the market to now push price to the upside. And where should be our take profit should be this point or negative 27. But usually, if you don't want to struggle at all, if you don't want to get too much of anxiety while trading, I urge you, you just simply target this high. Because the market flow is now that there's a retracement. Now that there's a retracement, once the retracement ends, price action is supposed to go take out this high. All right, supposed to push and take out this high. So that is how it is, guys. So if you have not subscribed to my YouTube channel, Against FX, all right, Against FX, that is my YouTube name. It's very simple. All you need to do is go to your YouTube, all right, just type Against FX. Just type Against FX and click enter. Then you will see. I hope you can see. You will see it's very simple. All right. You just, one moment. You go to your YouTube. You go to your YouTube, then type Against FX. You go to YouTube, type Against FX, click enter, or click search. Then you will now see this Against FX. You can see Against FX. Then all you need to do is just subscribe. Finish. Just subscribe. Click subscribe, and that's all. After you click subscribe, then you activate the bell sign, and that's all. Or you go to also our website, againstfx.com. Once you click enter, this is our website. So you have all those things that we offer our services, you see them there. You just go contact us, then we'll have you train. All right, as simple as that. Trading is very, very interesting. When you are struggling, it then means that you don't know what you are doing. And if you don't know what you are doing, you continue to struggle with it. And at the end of the day, you say trading is very difficult. That's why we say, come to us. All right. We are having a session, even our beginner session already is ongoing. You can key in, it's very simple. Key in and let us train you. All right. Our time is very flexible, 2 times in a week, and each section holds for the duration of each section is an hour, is 1 hour. So it's very, very easy. If you are a busy type, we can also work with your time. We schedule the time that is convenient for you. All right. That is how flexible it is. So thank you so much. And as far as I'm concerned, If you have gotten value from this video, please like, share, and subscribe. Or if you have any comment, you can leave your comment at the comment section. All right, and if there's anything you are struggling with, you just need some clarification, we are here to help you free of charge. So thank you so much. Just DM or send us mail and we'll treat that which you are having difficulties with. So thank you so much, and I'll see you again some other time. God bless you.